Hello everyone. Hope you guys are doing great. Have you ever wondered why a stock rises even when the economy looks bad or the company has not reported a great earning, and a stock falls even when a company post record profit? Because one of the main reasons is because the stock market does not price what is happening today. It how to say, it prices what is going to happen in the future. So in short, what I'm trying to tell you, the stock market is a forward-looking engine, and if you are able to understand this concept right, it will change the way we invest, and it will help us a lot, and it will avoid how to say, it will save us a lot of pain while investing. And obviously, to ensure that I cover all the points and everything, I made down the notes so that I don't miss out on anything, and I'll try to give you real life examples, plus theoretical examples at all. So think of stock market like is like a headlight in a car, right? So it does not, I mean, what does the headlight does, right? It illuminates where we are going, not where we are right now. So, and that's how stock market is, right? So the stock market generally reflects the price about what the company is going to earn in future, what will be the growth, and what is going to happen over the period of the next 6 months to 12 months. So, which clearly shows that the market is already prices what is going to happen in the future. By the time this news appears in the newspaper, or or the business news channel, the smart money is already invested and has already acted. So I'll just give you an example. Okay, let's say a company reported week's earning recently, and obviously you would expect the stock price to fall, right? But it does not happen. Why? I'll give you a live example. Right? Let's take the example of Arman Financial. If you would have, if we just look at the recent numbers, right? So for the past few quarters, if you see, they have reported losses, and if you compare to the profit compared to the previous quarters, it is quite less. But even though the earnings are not that great, the stock is still slowly and steadily rising, because the smart investors, right, they already know what is going to happen in the next quarter. Where is the actually company heading? They don't care what has happened in the past. All they care is what the stock market cares is what is going to happen in the future, and that is the reason why things are changing. Because if you look at the overall microfinance sector, things are getting better. The numbers are getting better. If you look at the the NPAs are reducing, the collection efficiencies are improving, the disbursements are growing. So the market already knows that, and it's already pricing even before the good numbers comes into even before the good numbers comes into picture. And if I want to give you a theoretical example, right, let's take an example. There is a company which has a market share of around 50%, and there is a company which has a market share of only around 2%. So obviously in the market, the value of the company which is having 50% market share will always be more, which is currently will be more than the company which has a market share of only 2%. But let's say in the coming quarters, the how to say, the market share of the company, first company, has come down from 50 to 45%. But for this another small company, the market share has risen from 2% to 5%. You know how the market will react? The market will punish the company which, where the share market has reduced, as you know, the market share is reduced from 50 to 45%, and the market will reward this company where the market share is improved from 2 to 5%. The market doesn't care whether the earlier company is 45% market share and this company is 20 is has 5% market share. What the market is seeing is, right, where the company is heading. They see that this company, which is a 2% market share, is becoming better and better. The market share is increasing, things are improving. But for the other company, which had 50% market share, things are getting worse, and the market share is reducing, which will have an overall impact. And that's how stock market prices these stocks. And that is the reason why sometimes we think, right, oh, the company has reported still good numbers, why things are looking bad? And whereas a small company, which is, the numbers are getting better, even though they're small, the market is rewarding them. So we need to understand this very clearly. And whenever you are, you are investing, right, you need to look where the company is heading and where the growth is. The market looks for improvement, and wherever there is an improvement, the money will chase those stocks. That is very clear, because we need to understand. The capital, overall capital is limited in the market. It will always chase those companies where things are getting better, where growth is coming back, and things are improving. No matter what the company has done in the past or how well they have done, the market doesn't care. All it looks what is going to happen in the future. So I hope you understood this concept. And if you have any questions, please do message me, or you can contact on my information, which is there on my YouTube channel. And if you like this video, please do subscribe to my channel. Thank you and God bless.